Welcome to our deep dive on Roth versus traditional 401k and the prioritization order that can save you millions over a lifetime. We will start with the universal foundation, eliminating high-interest debt and establishing an emergency fund, then transition into how to maximize tax-advantaged accounts and when to prioritize Roth or traditional contributions based on your income. We will also cover the role of taxable brokerage accounts for early financial independence. This presentation is educational and not individualized tax or investment advice. Here's the plan. First, we'll establish foundational principles for financial security. Next, we'll outline the investment hierarchy, emphasizing tax-advantaged accounts before taxable accounts. Then, we'll make the case for prioritizing the Roth IRA, followed by discussing when to pivot to traditional 401k contributions as income increases. After that, we'll explore why taxable brokerage accounts are critical for early financial independence. Finally, we'll reinforce concepts with diagrams, a couple of quizzes, and end with key takeaways and an action checklist. This content is educational and does not constitute legal, tax, or investment advice. Tax laws change and individual circumstances vary widely. You should consult a qualified professional before making decisions. Numbers such as contribution limits and tax brackets may change. Always verify current year values with official sources like irs.gov. We begin with fundamentals. If you have high-interest debt, typically 8 to 10% APR or higher, prioritize eliminating it because the guaranteed after-tax return from paying it off is often superior to market returns. Next, build an emergency fund of 3 to 6 months of essential expenses to avoid forced asset sales or new debt during setbacks. Once those two pillars are in place, direct savings into tax-advantaged accounts before taxable brokerage accounts, because tax deferral or tax-free growth compounds more efficiently over decades. After you've exploited those shelters, additional savings can flow to a taxable account. Roth IRAs deliver tax-free withdrawals in retirement, which means all investment growth over decades can be withdrawn without federal income tax if rules are met. If your current income puts you in a lower tax bracket, the Roth is especially compelling. You prepay a relatively small tax now to avoid potentially larger taxes later when your income or tax rates may be higher. For 2024, IRA contribution limits are $7,000 for those under 50 and $8,000 for those 50 or older. Confirm current year limits and eligibility. Also, be aware of income phaseouts for direct Roth contributions, which vary by filing status and year. This video emphasizes a Roth First approach for aggressive long-term investors. Roth 401k contributions are made with after-tax dollars, so there is no deduction today, but qualified withdrawals, including earnings, are tax-free in retirement. This is advantageous when you expect higher tax rates or higher income later, or you want more tax-free flexibility in the future. Traditional 401k contributions reduce taxable income now and defer taxes until withdrawal. This is particularly beneficial when you are currently in a higher tax bracket and value the immediate deduction. Both account types can coexist. Optimal usage depends on your present and expected future tax situations. When your taxable income is relatively low, often at or below the 22% bracket, Roth contributions can offer strong lifetime benefits, as you pay modest taxes now for future tax-free withdrawals. As your income increases and you enter higher tax brackets, switching new contributions to traditional 401k can reduce current taxes immediately. Over a career, a blended approach may be appropriate, but the core pivot is from Roth during lower earning years to traditional during peak earnings. Always reevaluate each year based on your expected marginal tax rate, employer plan options, and long-term goals. Taxable brokerage accounts offer penalty-free access to capital well before age 59.5, which is crucial for early retirement or career changes. While contributions are not tax-advantaged, these accounts allow unlimited contributions, tax loss harvesting, and flexible use of funds. The trade-off is the potential tax drag from dividends and realizing capital gains. Despite this, taxable accounts are a powerful complement after maxing out tax-advantaged options, enabling early financial independence while retirement accounts compound for later years. This mind map centers on wealth strategy and branches to 3 areas. Foundations include eliminating high-interest debt and building an emergency fund. The tax-advantaged branch shows maximizing the Roth IRA, selecting Roth or traditional employer plans depending on current tax bracket, and including an HSA if eligible. The taxable brokerage branch emphasizes liquidity for early FI, tax loss harvesting, and long-term capital gains treatment. The map helps visualize how each component supports both resilience and long-term tax efficiency. Follow these steps in order. Eliminate high-interest debt. Establish a 3 to 6 month emergency fund, then maximize Roth IRA contributions annually. Next, contribute to your employer plan using Roth when your income is in a lower bracket. As your income climbs, pivot new contributions to traditional 401k to reduce current year taxes. If you have access to an HSA and meet eligibility requirements, prioritize it due to its triple tax advantage. Finally, route additional savings to a taxable brokerage account to enhance liquidity and support early financial independence. This table lists 2024 federal marginal brackets for single filers. These values are examples and may change. Always verify current year brackets and thresholds on irs.gov. The 22% bracket is a commonly cited threshold when deciding between Roth and traditional contributions in this strategy. If your income places you at or below 22%, Roth contributions are often favored. As you move into higher brackets, the traditional 401k becomes more compelling for current year tax savings. This sequence diagram contrasts two earners. Alex is in a lower tax bracket and prioritizes Roth contributions for tax-free withdrawals later. Blair is in a high bracket and prioritizes traditional 401k contributions and possibly an HSA for immediate tax savings. Both can invest in taxable accounts after maxing tax shelters to build liquidity for early financial independence. This illustrates how strategy adapts to current income rather than being one-size-fits-all. Question: if you are in a low tax bracket today and expect much higher income later, which account type is typically prioritized under this strategy? Options: A. Traditional 401k. B. Roth IRA and Roth 401k. C. Only taxable brokerage. D. Skip investing until you're in a higher bracket. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Roth IRA and Roth 401k. When you are in a low tax bracket today, the strategy encourages paying tax now to secure tax-free withdrawals later. This typically maximizes lifetime after-tax wealth if your future tax rate is expected to be higher. Question: after maxing out tax-advantaged accounts, where does excess savings go if you want early FI flexibility? Options: A. Savings account only. B. CDs only. C. Taxable brokerage account. D. Don't save. Wait until retirement age. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Taxable brokerage account. A taxable account enables access to funds at any time without early withdrawal penalties, which is essential for early financial independence and flexibility. This pie chart is illustrative and shows how annual savings might be allocated after covering essentials. Early in a career, more dollars may go to Roth accounts. During peak earning years, traditional contributions may dominate to capture deductions. HSA contributions, if eligible, can fit in as well, and a remainder flows to taxable brokerage to fund near and medium-term goals. Actual allocations depend on personal circumstances and should be revisited annually. These are the core lessons. First, handle high-interest debt and build an emergency fund. Next, prioritize tax-advantaged accounts over taxable accounts. Favor Roth contributions when income is low and pivot to traditional as income moves up. Use a taxable brokerage account to maintain liquidity for early financial independence. Finally, reevaluate your plan every year because tax laws and personal circumstances change. To summarize, the recommended sequence is to address foundational risks first, then exploit tax shelters, and finally employ taxable accounts for flexibility. The strategy advocates maximizing a Roth IRA early, then using Roth or traditional employer plans based on your bracket, with a pivot toward traditional as income increases. A taxable brokerage supplements this approach by providing liquidity for early independence. Follow this order, but tailor it to your situation and verify current year limits and rules. Thank you for watching. If you found value in this breakdown, please like, share, and subscribe. Let us know in the comments which team you're on, Roth or traditional, and how you're thinking about your pivot point. Your feedback helps us create better content.